Patrick MontesDeOca with the Equity Management Academy live streaming from YouTube. On this segment, we're going to talk about gold, silver, virtual currencies, Coinbase, the US dollar, and interest rates. So we're going to have a pretty exciting session here, so stay tuned. We'll be right back. Welcome back, my friends. Let's take a look right away where we are here. Trading gold last at 1775.60, down about $7.50, and we're trading silver at 25.8450, down about 18 cents. Copper is slightly higher here at 422. 422 and a half, and we have Coinbase once again on the downside, down about 10 points, down to about 211.75. The Grayscale Bitcoin Investment Trust as well is down about 10%, down to 11 now in a fast market. Let's go back here to gold and pretty much see where we are on the day with regards to the VCPMI, the variable changing price momentum indicators for the day. For those that are just joining me here, what we do is basically use the VCPMI as a GPS for my trading. And it's a basic mathematical algorithm that identifies probability levels that for me as a trader, or for you as an individual trader, it identifies the extreme levels of the supply and demand for that specific trading session. In this case, we're taking a look at a day trading strategy to see if there are any signals for day trading. And the first thing that we do is we apply the daily data, the daily pivot points, overlaying a daily chart on a 15-minute basis that essentially extrapolates the probability factor by integrating the AI or the algorithm that identifies and ignites the extreme levels or the average price by giving it a color, a very basic color. In this case, you're taking a look at the average price for today to be at 1778. The extreme level above that average price is 1792, which is the sell 1 level. The sell 2 level is 1801. The extreme level below the mean of 1778 is 1769. The buy 2 level is 1755. Now, this represents a very simplistic visual presentation of the algorithm that within this simplistic presentation, it gives you a tremendous amount of intelligence. For example, the daily average price is 1778. And with the price closing below the average price, it's a bearish price momentum. Now, the AI tells you one of the rules basically is that when the price is around the average, it's a 50-50 standard deviation. So it could go either way for you. And the program essentially was coded to identify the extreme levels above that average price or probability factor of 50-50 standard deviation to the extreme levels above or below. And so we calculated a perfect Fibonacci sequence of 5 levels. And within those 5 levels, we identify the average price. And once we can identify the average price, then we can extrapolate the extreme levels above or below that average price. And the sell one level is a 1-to-1 factor with a 90% probability to the relative implied volatility of the mean, which is a 50%. So the sell one level is a 50-90% relative implied volatility to the mean with a 1-to-1 factor. The sell two means that it is a 50-95% relative implied volatility to the mean with a 2-to-1 factor. So you don't need, for the purposes of our algorithm, more than 5 levels, which is a perfect Fibonacci structure. And within those 5 levels now, we can see the extremes above that average price for the day or below that average price. The AI tells you, when you're trading around the average price, do nothing. What you want to do as a self-directed individual is you want to execute the highest probability trades. At least for me, that's what I'm looking for. So for right now, for day trading, it's neutral to bearish. Now, if the price closes above 1778, then it activates a bullish price momentum, negating this bearishness that you see here prior to this. Notice that the pivot points are static. They allow for the market to trade within those levels that essentially represent, in this case, the average price. And so what we want to see ideally as a day trade is for the market either to come down to 1769, which is the buy one daily, and then revert from there. Because the lower now the market comes down into this blue area, the higher the probability that we're going to see a reversion. Mathematically speaking, it's at the extreme level. If you look at the supply and demand, just for the day, in this case, talking about a day trading structure. Now, what I do is, as a trader, I use all the trends cycles, in order to get a picture of the landscape for me to make an educated guess, obviously. And I want to see how one cycle relates to the other cycles, meaning how the short-term cycles relate to the intermediate, to the long-term cycles, and see where I can identify what I look for is a harmonic relationship. It's a perfect alignment of price amongst all of the trends cycles. And if we're able to have that kind of an alignment, that is the most optimal level basically for a reversion to the mean to occur. And that's what we basically trade, is the principle of the reversion to the mean, or what we call mean reversion trading. Now, it's a mathematical model that basically identifies for you the relationship of the price of the market to these levels. And obviously, regardless of whatever fundamentals drove the price to these levels here, the algorithm will calculate mathematically those extreme levels. So for gold, right now, there is no position. Let's take a look at silver here. we have a mixture of signals here, which is really interesting for the silver market. Trading at 25.8650. Now, the daily numbers are on the left. The average price is 25.90. The sell 1 level is 26.22. The sell 2 level is 26.46. The buy 1 level is 25.67. The buy 2 level is 25.35. Now, what I want to point out to you is that we also are looking at the weekly numbers on the right of the chart, and also we have included the 360-day buy 1 level cycle by signal that's being activated at 25.85. As you can see here, on this bar, it's activating the 360-day cycle by trigger, which is a very significant trigger. The 25.90 is the daily average price. And so if we get above 90 now, it's going to engage the daily price, bullish price momentum. And when it does that, it automatically activates the target of 26.22. The 360-day cycle has the initial target, you might say, is the 26.59, which is the weekly average that we're looking at. So when you see the prices in relation to the daily, the weekly, particularly on the yearly and the daily, we're looking at an oversold condition. Below that, you're looking at levels of buy 1, buy 2 daily, and the weekly level is all the way down to 25.02. It looks like the market found buyers at this level here at 6 a.m. this morning. On this green bar, crossing above here, and crossing not only above the annual, but also crossing above the daily. Some profit taken once again, or supply, and the market is reverting right back up again. So this action down here is showing where buyers were identified. And on the daily signal, obviously it's in a neutral to bearish, so it's a little bit of a mixed signal between the two. But the predominant signal that we're looking at is the yearly cycle of 25.85 for the silver market. Let's take a look at Coinbase here, which is the platform essentially that is executing the virtual currencies that was an IPO just a little while ago at about 400 plus, and now we're trading at about 211.56. Trading virtual currencies is a different instrument than anything that I have ever seen in terms of the volatility factor that we're dealing with right now. And the virtual currency markets are a completely new landscape which deal with the virtual currencies, or the virtual economy, you might say, that is just exploding. And in that virtual economy, obviously, the US dollar fiat currency does not fit into that model, just in terms of the logistics. And so never mind if you look at it as a resort of, value, intrinsic value, or purchasing power. So besides the fact that we're moving into this new virtual economy, and it's no coincidence that, along with it, we're talking globally about virtual currencies and so on and so forth. And, arguments are being made back and forth about the legitimacy, the logistics of the application of Bitcoin as a virtual currency, and so on and so forth. So what you're really talking about really is the market is showing the need of a substitute asset to the US dollar, or even some of these other assets that are essentially the reverse or the opposite of the US dollar, which are gold, silver, metals, particularly gold and silver, and in particular silver, which has taken the basically not taken, but has, you might say, reactivated the currency aspect of silver, besides being an industrial metal. And I think when we talk about the U.S. dollar here, in with regards to what happened here after the pandemic here, then the issue that the U.S. dollar basically has to deal with is the fact that there is a tremendous amount of supply that is being implemented in the market. U.S. dollars are being printed out of thin air. The government balance sheets are exploding. Over $8 trillion for the Fed's balance sheet, and that is historic. So there is such a tremendous amount of money in the system of US dollars that obviously that supply is weighing on the intrinsic value and the purchasing power of the US dollar as the US world's reserve currency, as the US petrodollar. It's beginning to find challenges. People are looking for an alternative. Even countries are beginning, obviously, to see, and the thing is that it's not just the US dollar. The United States is not the only one who has suffered the consequences of this pandemic. And the Eurozone, Europe, Asia, most major economies are still dealing with the transformation into, first of all, this virtual economy, which is screaming to replace Bitcoin with the US dollar, or to use Bitcoin as a form of currency. And obviously, there are a lot of arguments being made politically and also economically in terms of the logistics of the application of Bitcoin in a normal economy, so to speak, or what one would think is a normal economy. We have transformed our economy from what we knew. As we knew it, the physical economy has become a virtual economy. It's a combination of both physical and virtual economy now. When you take into account, for example, Amazon, that now you can buy physical products through a virtual website. Yeah, you don't need to go to the supermarket and shop. You can have anything delivered from groceries to automobiles and anything else you want ordered simply by using the virtual economy. You know, you go shopping somewhere now when you can't find, you can find it physically in some of the stores, and so automatically, what they say to you is, oh, just go online, order online. And so we're in the middle of what I believe is a major reset, and we are trying to find a balance in terms of a currency that would fit into this new transformation, this new paradigm that we are experiencing economically. I think one of the major, again, coming back to the US dollar, I think what happened here last week, just to comment about Chairman Powell commenting last week on basically just talking about nothing. Nothing was said, nothing was done regarding the tempering, of purchases by the government. The only thing that was said is that, within 2 years, after 2 years, we'll see what the market does, and then we can, decide at that point whether we're going to raise interest rates. 2 years is a long time. Even a year is a long time for the way things are happening and unfolding in terms of volatility in these markets. So, but one thing I wanted to point out, even before the meeting, and I did announce this, and I posted, I published an article in the Associated Press and Seeking Alpha, that based upon the 10-year note that we're looking at, it doesn't seem to indicate that there are fears about inflation. The 10-year note has been trading around the 145, 150 area throughout all of this talk about inflation. I think what really has been hyperinflated is the talk about inflation. And the 10-year note, number one, if we just take a look at 149, it's at 149, and there hasn't been any major shifts or changing or inclinations that we're going to see another rise in interest rates on the 10-year note. So I watched the 10-year note pretty much to give me a very clear indication of what the market is anticipating. The other one that I've been tracking here very carefully is lumber. Lumber is an economic indicator as well, obviously, in terms of building materials for construction, housing starts, and that has collapsed to 907.50 now. It's down another 2 or 3% today. And so I don't see, what everybody's now, obviously the media and everybody talking about is after the fact with regards to inflation. But I think these are some of the indicators, obviously, that this guy's watch here with regards to inflation in this different areas here. The only other market that I would say is showing, pretty much some kind of inflationary indications, obviously, is the energy market. Crude oil trading at 73 cents. The WTI, Brent oil is at 75. So those are the areas that seem to be indicating that, and obviously it makes a lot of sense that as we move back into the economy, or what we call the normal economy here, crude is going to be very much in demand. So, but the issues that I think we're dealing with right now, which I believe are as a major cause of this spike in prices, which are being interpreted as inflationary, is simply the bottleneck squeeze, you might say, that we're having in the supply chain base that has been broken as a consequence, obviously, of the pandemic and the inability for people to go back to work. But even going back to work is going to take some time, at least, to replenish once again the inventory that has been essentially depleted. And depending upon the product, obviously, it may vary in terms of how long it's going to take. And some are natural that can't, push harvests, and so. But there's just a lot of different factors that are coming in right now and are affecting, food prices. Not only the broken supply chain in food prices, but we're getting one of the worst droughts in what seems to be hundreds of years. And so we have yet to see, how that's going to affect or put a premium, you might say, on soybeans. On food, and corn, wheat. But the market last week pretty much collapsed. I would say markets in general, in terms of commodities, metals, copper, palladium, it came down, gold, silver, to just unprecedented levels for particularly one trading session. And this is what I've been looking at when I'm trading coin, when I'm trading Bitcoin, Grayscale Bitcoin Investment Trust, even to simplify things without getting complicated with wallets and without putting it out at risk, you might say. I'm dealing with an instrument that is regulated. It's an ETF that trades Bitcoin. It's the Grayscale Bitcoin Investment Trust. So I am following Bitcoin in that sense, but my risk management may be a little differently than most people out there that are trading into these currencies here, these virtual currencies. And so, but coming back here to the virtual currencies here, one of the things that I want to point out to you is that the level of volatility that has been introduced into the market is unprecedented. And what that market is indicating is that the investor out there or the market out there can handle a much greater degree of volatility than what most people thought or were used to, based on previous standards. And so that is changing the complexion, you might say, of obviously volatility, and we have the possibility, obviously, that, bear with me, this volatility is going to be pretty much rampant throughout the markets here. I want to thank you again for the opportunity to share this with you, and I hope to see you again. Please subscribe so that we can continue to provide you with this incredible intelligence. We'll talk to you next time. Have a great trading day.